Hello, I'm Greg Hunter. Welcome to USAWatchdog.com. We have back with us once again Nick Barisheff, President and CEO of BMG, Bullion Management Group. He has about $600 million under management. Mr. Barisheff came out not long ago with a new book called $10,000 Gold. He is a gold bull and has lots of reasons for it. Mr. Barisheff, thank you so much for joining us today on USAWatchdog.com.
Well, thank you for having me. It's always my pleasure.
Well, let's talk about this recent, gold takedown, which ended up appearing, and at the time I thought it backfired in the face of the bullion banks trying to scare people out of gold, and it's surely the reports globally it has caused a stampede into physical possession of gold. Even Terrence Duffy at CME, Chicago Mercantile Exchange, was saying that people don't want paper anymore. They want the real thing. China is importing record amounts of gold. Russia, record amounts of gold. Everybody around the globe, private individuals, private wealth, everybody is importing and trying to scramble for gold. After all, it's on sale. What do you say about this?
Well, I think this is the first time this has happened. Usually when you have a drop in the gold price like we've had this time, and it's precipitated on the paper markets in the COMEX primarily, then there's also a drop in demand on physical. This is the first time that I can remember that it's gone the opposite way, that people are perceiving that the drop in price is like a gigantic buying opportunity. It's on sale at a lower price. Fundamentals haven't changed. There's no reason for that to happen, and there's a lot of speculation on why, but clearly there was a lot of gold sold on the COMEX, and as you know, on the COMEX there's really no limitations on essentially selling naked short any commodity. It's illegal in the equity markets, it's not illegal in the commodity markets. So as long as you have the financial strength, you can sell as many futures contract in any commodity that you want without ever having the commodity. So that kind of distortion, I think we've talked in the past, but you get situations like in 1998, Ford Motor Company bought $1 billion worth of palladium at twice the paper spot price. And the reason is you can't build catalytic converters and you can't build cars with paper palladium.
Yeah, that's right. Another thing about this phenomenon, which I wanted to kind of take this to the natural, logical chain of events here, is that it's causing shortages. It's causing a great stress and pain at COMEX and LBMA. Jim Sinclair is out, and he's saying that the emancipation of gold, the real price, is at hand. And of course, Jim Sinclair, Mr. Gold, one of the top gold people in the world. He also says that the bullion banks, not only they didn't just shoot themselves in the foot, they put the revolver straight to the head, shot themselves in the head on this deal, and he thinks that we're going to have a much higher price in gold because he thinks they're going to just run out of gold. They're going to have a force majeure. Either COMEX or LBMA is going to say, sorry, we can pay you in cash. What do you say about this?
Well, on the paper markets, under certain conditions, the futures contracts can be settled in cash versus the commodities. So that's been in place for some time. So the issue is if this backfires, and it's not all the bullion banks that have shorted gold on the COMEX, it seems to be restricted to a few. And what the motivation is behind that. But it certainly wasn't some fundamental change that caused a rethinking of the gold. The primary driver of this is the confidence in the U.S. economy, the U.S. debt, the U.S. dollar. Well, none of that has been fixed. The Republicans and Democrats didn't kiss and make up and all their issues resolved. The debt didn't go away. The Fed's $85 billion a month didn't change. All those things, if anything, are getting worse. So there was no reason for the drop. And I think people that have been following gold and watching it just saw that as a terrific gift. They were just given a discount to buy more, and that's what happened.
Do you think they could, have a force majeure? Do you think they could run out of gold at LBMA? Do you think they could, run out of gold? I mean, supposedly China, GLD lost, according to Dan Norsini, 293 tons since the first of the year. I mean, the amount of gold, China had a record of more than 223 tons imported in March alone.
Well, exactly. This is where the Eastern banks are buying with both hands and have been for some time, and that's accelerating. And that's a major fundamental driver. So that's been going on for some time now, and it's increasing.
But it's increasing.
Yeah,
Do you think this is going to cause the price to actually ricochet back up? Is my Jim Sinclair says the emancipation of gold. So my question to you is, do you think it's going to cause the price to, well, as you say in your book, start going this way towards $10,000 gold?
Well, the issue is that when you have this kind of a drop, and it was caused by paper shorting of gold. Then, if it reverses and goes the other way, you're going to have a massive short covering rally in the conventional sense. So that's a good possibility that's going to happen. But even if we go back to the 70s, like in 1975, gold went from 35 bucks an ounce to 200, dropped to 100. Now, I'm old enough to remember those days, and I remember how many people, literally threw in the towel. That they're never going to buy gold again. That's too big a hit. It's like a 50% decline, and then it went up eightfold to 1980 at 800. Right? We get an eightfold rise today. You're at 10,000.
That's right. You're at 10,000. Do you think you think that's Jim Sinclair says 3,500 is a minimum. It's going to go far above that. Do you think you're close on the price 10,000? Or do you think it could eclipse 10,000?
Well, I'm not saying 10,000 next year, and certainly I'm saying plus or minus 5 years. And the concern is that 10,000 isn't a peak by any means. If you hit 10,000, you're in hyperinflation. And talking about what the rest of it's going to bring is not a fun discussion. So I'll just leave it at 10,000 for now.
What's the rest of it going to bring? Give me a thumbnail of gold at 10,000. What are we looking at?
When you look at hyperinflations, you get ridiculous number. Like in Germany, gold went up from, I think it was 75 marks an ounce. A few years later, it was 23 trillion marks an ounce. That's what hyperinflation means. It's
like somebody said on Jim Sinclair's site, what's the last working parachute worth on a plane that is going down, that's going to crash?
Well, exactly. So this is what happens. But it's not so much the gold prices going up. It's obviously hyperinflation. The currencies are becoming worthless, and you get on this treadmill of having to print more and more. There's been 65 hyperinflations in this century, and they're all the same. We only talk about Germany and Zimbabwe, but there's 65 of them in total. And the numbers are just mind-boggling. They're hard to conceive, what it actually means. The difference this time around over the 65 other hyperinflations is that this time we're going to have a global hyperinflation based on all the currencies are fiat currencies, and the problems are the same. So that's what the major difference is going to be this time, and that's totally unknown territory.
Very insightful, sir. It's going to be very disruptive politically, right? I mean, isn't that what the French Revolution was about? French Revolution was about inflation at its core. People were suffering.
That's right. So that's the concern. To me, $10,000 gold is a relatively conservative estimate, because if I was reluctant to do projections like this in the future and so on and so forth, but when I listened to the debt ceiling debate in 2011, it became crystal clear that the debt situation wasn't going to get resolved. Doesn't matter who was in power or what they were going to do. There's no political will to make a decent dent in it. So the debt is going to keep accelerating, and the relationship between U.S. debt and the price of gold is almost a perfect correlation. I've got a chart of that in the book.
Let's talk about the bail-in scenario, and you wrote about this, and I'm glad you did, because you wrote all about it. And a lot of people are holding up this Canadian economic plan in a couple of specific pages. I think it's 144 and 145, where they talk about, taking other assets and not putting this off on the taxpayers. And of course, you vault your gold at Socia Bank, and you wrote a piece about this, saying, talking about the bail-in scenario specifically with you. You're in Canada. I'm talking to you. You're in Toronto. But you wrote a piece about this. Are they going to be able to take people's allocated gold accounts and get a bail-in?
See what you've just said is where the confusion lies.
Good. I'm the right guy.
As an allocated account. And this is where people, particularly in Switzerland, they open up a precious metals account, gold, silver, platinum. It's an account. It's no different than a cash account. When you have a cash account, you've basically given the bank your money, and they promise to give it back to you. They're not holding it in trust. It's no longer your money. You've given them a loan. And there's plenty of court cases in the U.S. that establish that point. So it's not your gold. It's not your money. The bank owes you the money or the gold, as it may be. And what just happened in ABM Ambro, where they apparently refused to give the client gold. Well, he never owned any gold. The bank, he had an IOU with the bank, and if you read the fine print on those agreements, they have the right to settle in cash. And given that it's the bank's money, if the central bank or the government passes legislation that says, we're going to take off 10% or do whatever, then they can. But when you have bullion, there's two very important stages, which we've got another article on that, which gives you a checklist and so on. But stage one is you have to buy the gold and have title transferred to you. You can't buy an allocated account. It doesn't exist. You buy the bullion first, and just like a car, a boat, a house, the asset is specifically detailed. In the case of bullion bars, you have the refiner, the serial number, the exact weight, and the exact purity. Just like an automobile where you have the vehicle identification number, the make, the model, the year, same thing. Yeah, you have to have those things to be able to transfer title. And usually there's representations from the seller and so on and so forth. So that's stage one. Okay, by having an account that says you've got, 1,324 ounces is not owning gold. You can't own ounces, you can only own bars. Okay? So that's step one that is missing. Once you own the bullion, you have to enter into an allocated custodial agreement. Okay? That's not an account. It's an agreement where the custodian agrees to hold on to your bars, and it sets out what he can and can't do with the bars without your permission. And this is where you come in. This is where your expertise is. Right. And this costs more, and that's where people have looked at that it's cheaper to buy gold through an account, but the point of it is they're not getting any gold, and the storage fees are minimal. There's virtually no premium over the spot price. So that's what's attracted people. But the banks don't have to have any gold, and if there happens to be a problem with the bank from a solvency point of view, you're at the bottom of the creditor pile. So you're saying when it comes to BMG, you have clear title gold in an allocated account, game, set, match, no bail-in, not in play, no way. We have to clarify it and so on. You can only have an unallocated account. So in our mutual fund, we have unallocated accounts because that's where the day-to-day transactions occur. Because one day you could have $10,000 coming in, another day you could have $1 million. So to facilitate the fact that we're not buying bars on a day-to-day basis in the fund, we have an unallocated account. We keep very little of the bullion in the unallocated account, about 1%. Because once the number of ounces accumulate in the unallocated account, we then has Scotia to deliver bars into custodial storage.
Got it.
So they debit the unallocated account, and they give us a new list of bars that are in storage. And you can see the bars on our website. We list all the bars that are in storage. And Scotia gives us a monthly report on that. So there's those kind of factors. And like I say, in our latest article, we've tried to make it perfectly clear that they have to own the bullion in the first place.
Got it. I got it.
And they have to have a custodial agreement, ideally with an LBMA member for maximum liquidity.
Oh.
But then it's your bullion. It doesn't form part of the assets of the custodian. Nobody can have a claim to it, and so on. So they're not going to start confiscating people's assets. But in terms of bank accounts and so on, that's not your asset in the first place.
So you think bail-ins in Canada, U.S., Europe, you think they're going to have? I mean, that's what they're talking about in Europe now, and they've already got this Canadian economic plan. You think they're going to take people's cash, people's money? That's going to happen.
Well, the thing is that if a bank was to become insolvent, right, then what happens is the assets are liquidated to the creditors in due course, and as a bank depositor, you have an insured component, which varies per country, but let's call it 100,000.
Yeah.
That's just uninsured. For the uninsured amount, you're an unsecured creditor, and typically there's nothing left for the unsecured. So it doesn't matter whether it's a local currency account, a foreign currency account, a precious metals account. They're all unsecured, uninsured amounts.
And you think bailouts for uninsured amounts are going to be bye-bye. And what happens, right? Is that right?
Well, this is the way it's been before, central banks were created to give people the illusion that their money is safe. Like when you put money in the bank, you need to look at the solvency and the credit worthiness of the bank, and if your money's at risk or not. Right now, we've got the situation where the interest you're getting paid by the banks isn't worth putting your money at risk, in simple terms.
Well, and for all the people that have uninsured accounts, what happened in Cyprus was, would you have 100,000 euros? And anybody who went to the bank and said, okay, great, I have 100,000 euros in my account, give me 50,000. Sorry, you can have 300 euros today. I mean, that's kind of an illusion too, isn't it? I mean, everybody with an insured account, with an insured amount, isn't going to be able to run to the bank and take it all out, right? So this is going to be a mess.
If you look at the FDIC insurance in the States, same thing in Canada.
FDIC insurance, I know what that is. It's $10.8 trillion in deposits. I just looked this up. And $33 billion in insurance. 10,800 trillion in deposits. 33 billion. That's like having $33 to insure $10,800.
Exactly right. And the issue is that it covers maybe the odd one-off insolvency, but it doesn't cover a systemic insolvency.
Nick Barisheff, thank you so much for joining us today. Glad to have you back on. Your book, $10,000 Gold, it's out finally. It's a thick book, man. It's a lot in here. Lots of charts, graphs, things like that. Thank you very much for joining us today on USAWatchdog.com.
Always my pleasure, Greg.